Welcome to our award-winning Consumer Finance Monitor podcast, where we explore important new developments in the world of consumer financial services and what they mean for your business, your customers, and the industry. This is a weekly show brought to you by the Consumer Financial Services Group at the Ballard Spahr Law Firm. And I'm your host, Alan Kaplinsky, the former practice group leader for 25 years, the founder, and now senior counsel of the Consumer Financial Services Group at Ballard Spahr. And I'm delighted to be moderating today's program. For those of you who want more information, don't forget about our blog, consumerfinancemonitor.com. Yes, it goes by the same name as our podcast show. We've hosted our blog since 2011 when the CFPB became operational. So there is a lot of relevant industry content there, including a lot of information about the topic we're going to be covering today, which I will very soon describe to you. We also regularly host webinars on subjects of interest to those in the industry. So to subscribe to our blog or to get on the list for our webinars, please visit us at ballardspahr.com. And if you like our podcast, please let us know about it. You can leave us a review on whatever platform you use, Apple Podcasts, YouTube, Spotify, or any other platform. Also, please let us know if you have any ideas for other topics that we should consider covering or speakers that we should consider inviting as guests on our show. So let me tell you about the topic we're going to discuss today. And I think this has been a long time in coming. I really feel a little bit derelict that we haven't covered this topic a year or so ago. But nevertheless, we're going to do it today. So we're turning our attention to a very important trend reshaping the small business credit marketplace. And that is the rapid proliferation of state statutes that require companies making loans to small businesses to provide detailed disclosures, particularly APR or interest rate type disclosures, and in some cases to comply with the substantive requirements that look very similar to traditional consumer lending laws. For decades, the regulatory framework for commercial lending was fundamentally different from the rules governing consumer credit. The assumption was that business borrowers were more sophisticated, that transactions were negotiated, and that the kinds of mandated disclosures and suitability protections used in consumer lending were completely unnecessary in the B2B context. That line has blurred very dramatically. Over the past several years, a growing number of states, including some very large states like California, New York, Utah, Virginia, Florida, Georgia, and many others, have enacted laws compelling commercial lenders, which include merchant cash advance providers, to deliver APR-style cost disclosures, payment schedules, prepayment information, and a host of other terms before any credit may be extended. The policy motivations here are very easy to understand. Many small businesses are operated by individuals who are not financial experts. A lot of what we would refer to as mom and pop kinds of businesses. They often obtain credit through online platforms. So there is no much negotiation at all. These online platforms offer short-term products with complex pricing structures. Legislators and advocacy groups have argued these borrowers need clearer, standardized information to compare offers and to avoid abusive practices, just as consumers do when they seek a mortgage, auto loan, or a credit card. But the statutes go well beyond paperwork. Several states have layered on substantive obligations, restrictions on fees, rules on refinancing, limits on the use of confession of judgment clauses, choice of forum clauses, and even requirements that providers meet standards of fairness and good faith. Perhaps even more significantly, a number of these laws now require state licensing or registration for companies that offer small business financing. That represents a major shift. Lenders that historically operated nationwide without commercial licenses must now navigate a patchwork of regimes, each with its own triggers, definitions, and enforcement mechanisms. The result is a marketplace facing real operation of legal complexity. How do these state requirements interact with federal initiatives like, and we will talk about this somewhat, Section 1071, the proposed regulation of the CFPB dealing with data collection, the FTC's negative option authority, or for that matter, general UDAP principles, state statutes to prohibit unfair or deceptive acts and practices, and sometimes include abusive acts or practices. Do the new laws truly mirror consumer protections, or do they create something entirely novel for commercial credit? And what are the compliance challenges for banks, fintech lenders, and coalitions seeking uniform standards? Or for that matter, non-banks that partner with banks to offer small business loans. To help us unpack these questions, I'm delighted to welcome Louis Caditz-Peck. Louis is the executive director of the Responsible Business Lending Coalition, one of the leading national organizations representing responsible providers of small business credit. The coalition has been deeply involved in advocating for transparent, workable rules at both the federal and state level, and has played a significant role in the enactment of a lot of the legislation that we're going to be talking about today. I'll be asking Louis to walk us through how this movement began, how he got involved in it. We're going to get into the consumer protections that exist in these statutes, the licensing requirements that are mandated by some of the statutes, and whether we are really witnessing what I'd call the consumerization of small business lending. We'll also discuss the perspective of borrowers. Do these requirements help them make better decisions? And the views of lenders, particularly smaller lenders, and those that want to offer innovative products while remaining compliant in every state where they operate. There's a cost associated with all this, and we're going to discuss how smaller companies that are engaged in small business lending can compete with the larger companies that have general counsels, in-house legal staff, compliance officers, etc. Access to credit is the lifeblood of small business growth. Yet excessive or inconsistent regulation can reduce availability or increase cost. Striking the correct balance between transparency, protection, and innovation is therefore critical. With this stage set, let me tell you a little bit more about Louis, and then I've got a lot of questions for Louis. So I've already mentioned that Louis is the executive director of Responsible Business Lending Coalition. We'll call it RBLC. And they're an industry and nonprofit voice on small business financial protection and innovation. They represent over 1,000 small business groups, for-profit lenders, CDFIs, and nonprofit community advocates. The board of RBLC includes Small Business Majority, Quantum Lending, Opportunity Finance Network, the National Community Reinvestment Coalition, and it's chaired by the Aspen Institute Business Ownership Initiative. These for-profits and nonprofits have come together to stop the rise of predatory small business lending and to improve access to capital by small business. Now, Louis was previously at the Fintech Bank of Lending Club for 10 years, having joined in 2013 to launch Lending Club's small business lending program. Before that, he was a commercial lender at a self-help credit union, CDFI. He also co-founded two trade associations, the American Fintech Council and the Marketplace Lending Association. So, and finally, I should mention, served as a member of the CFPB's Consumer Advisory Board from 2021 to 2023. So, Louis, a very warm welcome to you. Delighted to have you on the program, long overdue.
Alan, I'm so happy to be here, and I've learned so much over the years from the Consumer Finance Monitor blog and the things you post on LinkedIn, and so it's really fun to be here and talking with you about this great topic.
Okay, well, let's get into it. So, I got into some of this during my introduction, but don't let that stop you from underscoring some things that I might have said. Either you agree or disagree. But why has small business financing lawmaking become so much of a trend at the state level in the last few years?
Yeah. Thanks, Alan. I think, as you talked about, everyone cares about small businesses so much. Small businesses have created 70% of jobs since 2019. A lot of us have very personal connections to small businesses. I grew up in a family small business myself. And small business financing is such an issue that has tremendous buy-in from state, federal, across the aisle. 65% of small business owners have said they found it difficult to access affordable capital, according to Goldman Sachs study from last year or so. And as you talked about, there's a tremendous change happening in small business lending, particularly since the 2008 crisis. There was a big pullback from some of the traditional bank lenders. Community banks have been, historically the backbone of small business lending, and the numbers of community banks have been declining. They're facing challenges. And so that's created a kind of a space that different lenders are filling in different ways, and technology is creating opportunities to make lending better than ever before in that space. And the fintechs and CDFIs and other lenders in our coalition and folks outside the coalition are demonstrating that. So that explains the attention to the topic. But why the lawmaking? I think a lot of state lawmakers are concerned that things are not going in the right direction on their own. When our coalition launched in 2015, Michael Barr, now one of the governors of the Federal Reserve, formerly the vice chair of supervision, spoke. And what he said in announcing this coalition was that the problems that we're starting to see in the small business lending market are extremely troubling, and in some respects, reminiscent of some of the problems we saw in the subprime mortgage sector in the lead up to 2008. So specifically, what is he talking about? He's talking about a really large growth of issues of misleading pricing, financing that's just beyond what the business taking it can afford to pay, brokers steering people into deals that pay the broker the highest fee, even if they are not the best deal for the borrower, business models that are built on getting people to take financing they can't afford and reborrow it over and over again. And so you see the parallels that Michael Barr was talking about. And that's endangering not only those small businesses, but our opportunity, but also the ability of responsible lenders to grow and thrive and compete effectively in the market, and our national economic stability and prosperity.
Mm-hmm. Well, let me ask you this. For how long has the coalition existed?
We launched in 2015.
Okay. Oh, so it's actually existed for a much longer period than I thought. Were you the first executive director, or did you come on later?
I was one of the co-founders with how this coalition came together and became the first executive director about a year and a half ago. Prior to that, we were functioning as a coalition kind of governed by the board. And this came about in 2015 as so many stakeholders in small business financing were, as we were interacting at conferences about whatever it was we were talking about, this theme of, gosh, can you believe what's happening in the market? Can you believe what we're seeing happening to our customers? Our small business borrowers are getting overwhelmed by financing from other sources that are setting them up to fail. How do we create rules of the road that let innovation really thrive? And so that really predates this.
Do you think that the impetus for it was caused by the internet and the fact that more and more often commercial lending was being done over the internet? And when things are done over the internet, the borrower doesn't usually get to meet the people who are running the company, and there is a tendency for there to occur, let's say, not necessarily fraud, but sometimes fraud, but business practices that aren't the most savory.
Well, the coalition really formed to try to answer that question in a more nuanced way, because online access has so much potential to improve financial inclusion, to improve access, to get capital more efficiently to smaller businesses. And so the thing that really, I think, brought the for-profits in the coalition and the nonprofits together when we gathered was that there were, going back to 2015, kind of two prevailing narratives about what was happening in small business financing. And one of them, like you were saying, is a lot of people were saying online financing is bad, it's predatory, and traditional financing is good. And some people were saying traditional financing is bad because it's exclusionary, it's not meeting the need for access to capital. And so online lending is good. And this group got together to say that obviously both of those are wrong. Responsible lending is good, and irresponsible lending is bad. And what matters is not whether it's online or offline or bank or non-bank. What matters is the practices in which that product is delivered. And so what brought this coalition together was the joint development of the first standards to really define what is responsible lending for small businesses. And that's called the Small Business Borrowers Bill of Rights. And so at the Aspen Institute, this set of fintechs and CDFIs and small business groups got together, and everyone shared their views, and we hashed out an area of consensus agreement, which were 24 specific practices that ladder up to 6 rights that make up that Small Business Borrowers Bill of Rights around transparent pricing and terms, responsible underwriting, collections, broker treatment, inclusion.
Did that really become the prototype, or the template, I should say, for a lot of the state statutes?
Yes.
Yeah. Okay.
In fact, the very first of these in 2018 was California's SB 1235, and RBLC had actually started as a purely self-regulatory initiative. We just said, we're publishing these standards and we're inviting other lenders and, community groups and small business groups to sign on. And what happened was legislators started coming to us and saying, we want to turn this into law, or we've already turned this into law and we've introduced a bill. And will you come help us on this bill? And that's really that's what happened in California that led to the first small business truth in lending law in 2018.
Interesting. And so just talking about the coalition for a moment, I got the impression from you that the members of the coalition aren't just small business lenders, but that also includes business borrowers or people who would typically advocate for consumers. Am I right, or is it really just limited to those that
No,
are
you're
in?
right. There's three main constituencies that make up the coalition, and those are lenders to small businesses, which include online, offline, CDFI, fintech, different structures, small business groups that represent something like, over 100,000 small businesses among the different small business members of the RBLC, and community groups and advocates. That's folks like National Community Reinvestment Coalition or others like that.
Right. So then I've now figured out I was going to ask you why you don't call it a trade association and instead you call it a coalition. It really is quite a bit different from, let's say, a trade association like American Bankers, Consumer Bankers, American Fintech Council, et cetera.
Yeah. And we work closely with those. American Fintech Council is one of the endorsers of the Small Business Borrowers Bill of Rights, and they're actively part of the campaigns we work on. But what makes RBLC, Responsible Business Lending Coalition, unusual is exactly what you described. Right now, there's so much division. This is one place where there's a big tent that has crossed for-profits and nonprofits and small business voices to all say, we got together, we hashed things out, we got rid of the stuff we couldn't agree on, and here's what we could agree on as a big tent consensus to move forward.
So did it originally start with the idea of developing the Bill of Rights, and then that was the jumping off point, and then as more and more states started taking an interest in the subject and wanting to enact some kind of protective statutes, you got more involved in lobbying or at least assisting the various states in drafting statutes that struck an appropriate balance, protecting the borrowers, but at the same time treating the lenders fairly.
That is exactly right. And the impetus to move from self-regulation into policy also came from the lenders, because at some point they were saying, we want not only ourselves to be recognized as folks that are following responsible practices, but we also want our competition to be on a level playing field with us. And that might be a good way to just explain. We have a little mnemonic to describe our strategy now as it's evolved into policy, which is set the standards, change the market, change the laws to change lives. So that's begun with first setting those industry standards, the Small Business Borrowers Bill of Rights, then changing the market through voluntary adoption of those standards. So there's over 100 organizations who in turn represent more than thousands in some cases, because they're membership organizations included, that have signed on to these standards to say, we follow these standards in our lending, or, we're a group like, we're not a lender ourselves, we're the National League of Cities, we're the U.S. Hispanic Chamber of Commerce or something like that, and we endorse these standards as the right thing for the market. And then the third part of that is changing the laws. And so thus far, we've helped to pass 7 state laws now. As of September, we hit our 7th, where we were the primary drivers of that law, as well as many more that we.
Yeah. Can you just very quickly rattle, and we know California is in there. I named a bunch of them, but I'm not sure I named 7.
Yeah. So the 2 lead state laws have been the California and New York Small Business Truth in Lending laws. And then we have been also, so we've just passed 5 more additional laws in California that have addressed UDAP protections, collections practice standards, improvements on the truth in lending framework in California to try to better harmonize it with other states and to try to respond as folks come up and have ideas for improvement. And that includes a law that was just passed in September unanimously, led by the banking chair in the Senate, Chair Grayson.
So you've got New York, California. What are the other 5?
So there's 6 laws in California that we've been leading on.
Yeah, I mean, just in California, I understand there have been a number of statutes. Were they incorporated into the original statute, or were they kept separate?
A little both. And so to date, by my count, since that first one in 2018, there are 19 total small business financial protection laws, some of which we've supported, some of which we haven't. And those cover a lot of states. And I want to circle back to something that you said, which was so correct, about the goal is how do we find the right, how do you hit the right balance between laws that help the borrower and don't burden the lender? And our perspective on that is when you hit the right balance, it's not just balancing a tension between these two things, it's really helping them both. It's the right balance in a law ends up where you're improving innovation in the market. For example, if you're bringing price transparency to the market, that is improving the innovation environment in the market. It's making it easier for lenders to innovate because they can compete on price. There's a reward in the market for delivering, for innovating, for how you can deliver better, more affordable capital. And so it's less about like anything that's good for borrowers is bad for the market, but more about how do you try to have fairly light touch interventions in the market to create an environment where innovation really thrives and financing is getting better and better for small businesses and for lenders.
All right. So going back to 2018, California started, as it usually does, a lot of trends begin in California. And there seems to have been a lot that happened last year. So what changed in 2025? Did it by any chance have anything to do with the change of administrations at the federal level, or was something else?
You know, I think that's a factor. And I also think that this is an issue that is just starting to have been around long enough and grow long enough that people are really noticing it. You know, Goldman Sachs last year published a study. Last year, it's January, it's the beginning of January. So they recently published a study finding that 28% of small businesses said that they were affected by predatory lending within the last 12 months. As of 29, so this is a big thing, and legislators are seeing it. Everybody is starting to see it. You know, already as of 2019, the volume of what the Federal Reserve describes as, quote, higher cost and less transparent credit products had already grown to more than 6 times the size of SBA lending for amounts of $250,000 and below, which is the Main Street Finance size we're most focused on. And that was as of 2019, and it was doubling every 5 years, according to the research. And so this is like, it's not really a niche issue. I think what people are seeing is it is taking over small business financing and setting us on that path that, 10 years ago, Michael Barr was warning about. And so in 2025, there were a bunch of developments. We saw at Treasury, at CFPB, under both administrations, at the SBA, at the Fed, in different states, red states and blue states, action on this. And I can describe some of those if it's time to get into them.
Yeah. Yeah, I think we probably, because we have a lot to cover, Louis, I think we'll put that off. And if we have some time at the end, we'll circle back to that. So everything sounds terrific. Hunky-dory, I guess. That's an old cliche. But there's always downsides to all this state regulation. As I said in my introductory remarks, there are costs associated with this. And it becomes particularly difficult for smaller companies or startup companies to compete with the larger companies that are already in the small business lending business, who have in-house counsel. They already have the infrastructure in place. Isn't that a problem? I mean, and how do you deal with that problem? Because you don't want to discourage more companies from entering the business, and you certainly don't want, except for the bad boys, that the ones that aren't treating borrowers fairly. You don't want to see companies drop out of the business because they can't compete anymore. The costs are too high, and they can't cover all the costs by jacking up the interest rates because they're competing with lenders that don't have the same difficulty as the startup companies have, or the small companies. So how do How do you deal with that conundrum?
That is a really important concern. And it gets to this question of how do you have the market work in a way where the best ideas can thrive, where people can come up with new types of small business lending, new entrants to the market, deliver better products, more affordable products. And that is exactly what we are trying to do and focused on. So just to speak from my own personal experience, most of our lenders, just by number, are small lenders, and they are grappling with exactly these kinds of questions. How do you compete effectively in the market? And my experience, having approached Lending Club and back when it was a consumer lender exclusively, and pitched them and saying, hey, I think you guys, at the time, this is a long time ago, but at the time the CEO was saying, we're going to transform and replace traditional finance. We're going to expand from consumer lending into maybe mortgage and small business mortgage lending and student lending. And I approached them and said, I think those are bad ideas. I don't think they're a good fit for the business model, but small business lending and used auto, I think are. And I joined the company to work on what ended up being small business lending. And they also went into used auto. And we, Lending Club, I was there. We went through the IPO a little after that, raised $1 billion. And so we had a lot of equity behind us and put a portion of that into how to innovate in small business financing and deliver better financing than was otherwise available. And part of that strategy was to be the lowest cost financing that a small business could get online while properly managing risk, and be as fast and easy as the rest, as some of the fastest and easiest financing the business could get online. And what I found was that strategy of being lower cost really had challenges because customers could not tell that our products were lower cost. And that was our biggest challenge. It wasn't that compliance costs were high because, to tell a customer what price we're going to charge them, that's not a serious compliance burden. That was not a challenge. That did not add significant cost to our business. What was a challenge to our business was losing deals over and over again to competitors that were offering a much worse product because the customer could tell. So, this is San Francisco, open floor plan. And I can hear all the conversations happening of our, the folks that are talking to the small business owners, the kind of loan officer type folks. And they would be having this conversation just constantly where they would say, hey, Alan, congratulations, you're pre-approved. We can lend to you at, I'm going to make up a number. The average APR at the time was about 22% that we were charging. So, we can get you financing at 22%. And the small business borrower would often say, well, such and such company is offering me 10%. And then a loan officer would say, okay, but when they say 10%, what is that? Is that an APR? Is that an interest rate? Usually it was bullshit. It just meant it was a percentage number that had no relationship to how we compute a real interest rate, and was probably equivalent to an interest rate of, in some, if they're saying 10%, maybe it was like 40%, maybe it was like 300%. But the business owner didn't know who to trust. And so that was what was squelching innovation. And that is what continues to be squelching innovation. But we do need to keep compliance costs low. And that's something we focus on.
Yeah. Does your coalition help with compliance? Do you put together disclosure? Well, first of all, is it possible to to use uniform documents? One set of documents, including disclosures, that will work in all these states? Or do you have to have separate documentation in a lot of different states?
Yeah. So we've been very focused on interstate harmonization. Like I said, the first bill that was passed, that we led to passage, was in California. And the second one was in New York. And in the rule writing for those states, we advocated for things to make sure that lenders could use the same form in both states. For example, the regulators had initially had the form state New York or California on the forms, and we asked them to remove that so that you could just say this is the disclosure form and use the same one in both states. And we've gone back to California to increasingly harmonize it with New York. There have been other stakeholders that are also driving some of the lawmaking in this, and that's really muddied the water. So some of the laws in other states, they take a different form, which I think is breaking that interstate harmonization. And those are laws that are generally basically led by the merchant cash advance industry as a way to try to prevent a real truth in lending framework that is harmonious with the ones that have established to be passed. We don't really view them as generally doing a real significant benefit to the borrowers in terms of improving transparency. They're more about creating the appearance that something has been done without actually disclosing the stuff that's missing. And that's been sort of breaking. That's been creating more of a compliance challenge for lenders with different requirements, different states.
So you mentioned merchant cash advance. I mentioned it in my introduction. Are they, any of those companies, a member of your coalition? Or are they? Do you really not want them in there because they're considered a different animal?
There are some companies in our coalition that offer revenue-based financing. And the real focus of our coalition, like I said, is about responsible practices. So our view is that for the most part, any product structure should be able to be offered responsibly. It's not about, is something a merchant cash advance or not? It's not about, is merchant cash advance bad or not? It's about, is this transparent about the price? Did it assess the ability to pay so that the borrower can repay it? And the other 24 specific practices that make up the Small Business Borrowers Bill of Rights. And there are some revenue-based financing providers that are in that space. Candidly, it tends to be CDFIs that are doing revenue-based financing so far that do it that way.
Yeah, why don't you, because although I'm sure a lot of our listeners, probably most of them, know what merchant cash advances are, some of them may not. And I always like to make sure that our listeners don't have a lot of questions in their mind after they hear our podcast show. So what is a merchant cash advance?
Merchant cash advance is a type of financing that people would now categorize under what they would call revenue-based or sales-based financing, where instead of payments being in a fixed amount, they are a percentage of the borrower's sales, say 10% of your sales every day. So if you sell $10, your payment is $1 that day. If you sell $100 of stuff, your payment is $10 that day. And so the repayment term is not fixed. The repayment amount is not fixed. The amount you have to repay is fixed. So the basic deal is, I give you $50,000 and you repay $60,000 at a rate of 10% or 35% or whatever we see of your daily sales.
Mm-hmm. Okay. Let's turn to some other topics, of course, all related. CFPB. What have they done? Well, let's say we'll talk about it in two segments. What was their involvement in small business lending Trump 2.0? And then what's happened under Trump 2.0?
Yeah. Well, maybe we'll circle back to 1071, which has been the CFPB's main function in small business has been 1071.
Yeah, well, maybe we'll get into that right now.
Okay.
1071, because that actually was part of the original Dodd-Frank Act.
Yes.
That there weren't many things that Congress mandated the CFPB to regulate about, but 1071 is one of those.
Yeah.
But yeah, I want you to give a Reader's Digest version. We can't get into all the details and the ups and the downs, but basically, what did 1071 cover, and what was the former administration doing about it? And then how did it change under President Trump?
Okay. So Section 1071 of Dodd-Frank asked the CFPB to write rules collecting data from lenders so that we could know for the first time how much small business financing is actually happening, who is actually getting small business financing, and on what terms. It's similar to what's already in place in the mortgage market under the Home Mortgage Disclosure Act.
Is it a way to see if there were discriminatory practices that were being engaged in by small business lenders?
Yes. The two statutory goals described in Dodd-Frank are, one, to help the CFPB identify if there's discrimination happening, and B, identify where there are gaps in the market where small businesses are being underserved. And that's one that we also get really excited about. RBLC has been advocating on 1071 as a kind of unusual for-profit, nonprofit, small business, shared voice going back to just about its founding, with that same angle that we talked about before of how do we help this be something that hits the right balance, that is helping more innovation happen, that is improving small business financing. And so our focus in 1071 advocacy has been about how can this data collection help identify what actually is working in lending to small businesses, and how can that help innovators that are doing stuff that is working, whether they're fintechs or banks or CDFIs, be recognized for their good work and have growing business opportunities as a result. Because when that data gets collected, it's going to show what types of products, what types of business models are effective at lending to small businesses at affordable prices, if pricing data is included. This is something that is being rolled back that we're quite concerned about. And then if the regulation can help identify what really works, then that will create then everyone basically in the market will want to replicate that. They will want to build, buy, partner with what works. And that's going to hopefully, if it is able to move forward, create a lot of innovation and opportunity for companies and improvement in access to capital for not only businesses, but the whole economy.
So that was moving forward under Director Rohit Chopra, and a final regulation got issued, right? Then there was a lawsuit, maybe more than one.
Yeah, at least three,
challenging the legality of the regulation. And then Trump came into office, and what happened?
Yeah. So the rule was finalized first in 2023. In November of last year, just 2 months ago, the current administration introduced a notice proposed rulemaking to scale it back, slow it down, and that's basically held in the same uncertainty as the fate of the entire CFPB.
Yeah. So, and of course, we've done other podcast shows, and we're going to be doing more on that topic, but very uncertain whether Russell Vought, the acting director, has indicated he's running out of money. They're going to have to shut down the CFPB. There's 3 lawsuits pending dealing with that issue. There's a big issue over whether during the period when the Fed was losing a lot of money beginning in September 2022, that is the Federal Reserve Banks, what was lawful for the Fed to fund the CFPB.
Well, Alan, I found your writing on LinkedIn about that to be particularly interesting and insightful about what what the CFPB under Russ Vought has said about the issues that we've also been talking about in this podcast. In that notice proposed rulemaking that they issued in November, one of the things they said is that concerns about high costs and predatory practices in the merchant cash advance market, they suggested that those, I'm quoting, be addressed by federal and state law enforcement agencies through their respective enforcement authorities. And under the FTC, under the current administration, we've also seen Chairman Ferguson talking about doing exactly that. And interestingly, to your question earlier about are we seeing that blending of the consumer and small business legal regimes, what the FTC Chairman Ferguson said was American workers and small businesses are consumers too. And the commission is taking a comprehensive approach through enforcement and advocacy to ensure that they're not held back by unfair or deceptive practices. And he talked actually about some of their enforcement actions.
Yeah, podcast show, Malini Mithal. She was on several months ago, and I certainly came away with the impression that what's happening at the FTC is the antithesis of what's been going on at the CFPB. Makes one scratch their head because it's all part of the same administration, the executive branch, independent agencies maybe,
There's definitely this real tension in this. It seems like there's different stakeholders, and sometimes the focus is really on reducing the scope of government, and in some cases the focus is really on a very muscular and aggressive use of government power.
Well, I think what has saved the FTC, maybe the only thing that has saved them from the wrath of President Trump, is the fact that they enforce the antitrust laws as well as enforce certain consumer protection laws. And the Republicans, I would say that's more of a bipartisan issue. And the Republicans certainly don't want to jettison what's happening at the FTC in the antitrust area. And Chairman Ferguson and his two Republican colleagues, there are no longer Democrats on the Federal Trade Commission because President Trump fired them. And that case is up before the U.S. Supreme Court. But it seems like he's been given quite a bit of leeway. It's not exactly what's been going on at the CFPB. I want to move because we're beginning to run out of time, and I want to get into some other areas. First of all, what is a small business loan? A lot of people, when you think of small loans, you think of payday loans. If you do a lot of consumer finance regulatory work, and those are loans of only a few $100s generally, up to $500 or $1,000. But I take it here, we're talking about sums that in the consumer area would be considered large, but not in the small business area.
Yeah. What we have supported and what the vast majority of these truth in lending laws do is apply to financing to a commercial entity in amount of $500,000 or less.
Is that what applies pretty much across the board?
There's some variation. Actually, something a bit funny that happened in New York. So all of the states have a $500,000 cap, other than Connecticut's is $250,000, and New York's, we passed it with a $500,000 cap, and New York has this process. What is it called? I can't remember what it's called, but the governor can change the text of a law after it passes before they sign it in New York. And they did that under Governor Cuomo, and Governor Cuomo increased the coverage to $2.5 million after we passed 100,000.
So New York is $2.5 million. And does it cover open-end credit as well as closed-end credit? Does it cover secured as well as unsecured loans?
So there's variation on this between the different states. What we advocate for and point to New York and California on is that they cover closed end, open end, which is like a line of credit, closed end traditional loan, open end line of credit, as well as sales-based financing or merchant cash advance, factoring, and even a kind of catch-all other category so that people can come up with new ideas and not have.
Is there any type of commercial loan that isn't covered? Is there that? And we're going to get in a second to entities and which ones are exempt and who's covered. But what about types of commercial loans?
Our goal, both as lenders and as small business advocates, is to have a level playing field. So that if you're a small business and you're saying, I need $100,000 and I could get that $100,000 for whatever my purpose is through a loan or a line of credit or a merchant cash advance, or I could factor some invoices, that you have each of these kinds of products has their own pros and cons, and you want to consider those, but we want to give people also the best ability to make comparisons of what's the relative cost of using these with some common metrics.
So it covers everything.
Yeah. I mean, there's some things that aren't covered. Like, we made sure that the text exempted leases that are not lease financing. We tried to cover finance leases that are financing. There's finance leases, and this is a very nuanced and esoteric area of law. But that was cool. Some other rules, if you look at Virginia and Connecticut, they only cover sales-based financing, merchant cash advance. And Texas is a really interesting one that passed this year. candidly, we weren't behind that. That wasn't one we supported. That was kind of driven by the factoring industry, who has become very upset at the merchant cash advance industry by basically taking down their borrowers with unaffordable credit. And so the Texas bill is actually in some ways it's absolutely the most restrictive in the entire country with respect to the operation of the only product category that it applies to, which is sales-based financing merchant cash advance. It goes so much farther. Like I've said, RBLC's perspective is to create a level playing field where innovation can happen across types of products. The Texas bill actually has tried to block a lot of merchant cash advance from happening. It has a requirement that says if you are offering sales-based financing, you can only take payments from a borrower's bank account if you have a first position lien. But often you don't, because the borrower has already taken financing from someone else. And that was basically intended to, as I understand it, to stop a lot of that financing from happening. And that wasn't something that we were driving. But also it speaks to your question about the breadth of coverage, because it has not been an effective law, because it was signed in, I think, June, and to go into effect in September of last year. And before it ever went into effect, all of these merchant cash advance companies were advertising how they're continuing. They had these big advertisements that said stuff like business as usual in Texas, because they just converted their products to closed-end loans. So they weren't subject to that. And they continue to be like short-term, really expensive financing that isn't based on the borrower's ability to repay, but it has a little different structure. So it evaded that requirement.
Do any of these state laws have interest rate caps on them, or is it whatever rate is agreed to with the borrower?
They do not have interest rate caps. The factoring industry initially tried to put a rate cap in that Texas bill. Texas rejected that. The text that came out in Texas swung from putting in a rate cap to making it illegal to put in a rate cap. And RBLC's policy agenda does not include rate caps. We're actively working on bills like this.
What about other restrictions, such as restrictions for a closed-end loan, the maximum term of a closed-end loan? Nothing on that, or anything dealing with payments. It's I take it the requirements are in the nature of disclosure, as opposed to...
There's some things that go beyond that, which I'll describe. But the principle of everything the RBLC does is, if you are a small business lender that is already in the norm of what is good practice, that's what we're trying to help. And if you are outside of that and you are doing things that are irresponsible to take unfair advantage of small businesses and of your competition, that is what we are trying to prevent. So Maryland is an example. We've been working for several years with the Maryland Retailers Alliance and other small business groups and the Maryland Bankers Association in trying to pass a small business truth in lending bill in Maryland. And that came to us from the Maryland Retailers Association because they had a board member, a toy store, that took, actually in this case it was a merchant cash advance, and it basically destroyed their business. It was unaffordable, and this was something that they were seeing elsewhere. They talked about it, and they put forward a bill to ban merchant cash advance in Maryland. And they came to the RBLC, and they came to us, and they said, will you help us pass this bill? And we said, that's not really what we're trying to do. We're trying to set practice standards, not ban product categories. And so that bill didn't move forward. And the next year they came back to us, and they said, okay, we're going to do a price cap. And we said, that's not our policy agenda. We're not trying to do price caps. And then the next year, they said, what can we do together? And we said, well, one thing we're advocating for is price transparency standards to try to create price competition in the market and help people make their own decisions. And that's what we've been working with them on. And that bill has passed unanimously out of the Senate for years.
Let's turn to exemptions. Who's exempt?
Yep. Primarily, banks are the biggest exemption. There's some other exemptions for.
Would it cover all kinds of banks or only banks in the particular state?
So all of these truth in lending laws generally they cover financing to small businesses that are in that state, regardless of the location of the lender.
So you just answered another question, and that is, would it apply to let's say, a borrower who's in North Dakota, where there is no statute, who's borrowing online from a lender in California or New York where there is a statute?
The statutes apply to financing to borrowers that are located in the state, not the conduct of lenders in the state on what they're doing outside of the state.
So you're saying my hypothetical borrower in North Dakota, lender in California, lending online to the North Dakota resident.
Yeah, you can BS them as much as you want about what the price is, subject to whatever exists in North Dakota law. You don't have to follow California's law in North Dakota.
At all. Okay. All right.
As far as I understand.
Yeah. Okay. But banks are exempt. So I do a lot of work for banks. So I don't mean this as a negative comment, but why should banks be exempt? Why should anybody be exempt? Borrowers who want to get a commercial or business loan, or they might look at banks, they might look at non-banks. If they go to the banks don't have to comply with any of these disclosure laws.
Yeah, that's a strong point. I think what we hear from some banks is that they wouldn't mind being on a level playing field. Banks are also obviously quite active and concerned about the compliance cost question that you raise, and they are a strong political force. And they're often the best financing that's out there for many small businesses. And in terms of disclosure, the real missing piece that we talk about a lot is APR. That's not the only thing that's important by any means. Other things are also important. The payment amount, the total dollar cost is important, the finance charge. But APR is also a necessary, if not sufficient, piece of data. And for most bank credit, the APR is sometimes being disclosed. And if it's not, usually the interest rate is being disclosed. And on most bank credit, the interest rate and APR are pretty dang close because there usually aren't large fees. That is really different than if you look at a lot of the online loans. In some cases, there's no interest rate. There's just a really big fee. And so you have to use the APR to capture that, because APR is inclusive, obviously, of interest rate and fees. So banks are often in the ballpark already, but there are arguments, as you point out, for a level playing field. But banks are also working with us in some places, like I mentioned in Maryland, where one of the leads of that campaign is the Maryland Bankers Association. And what we hear from other banks is that increasingly irresponsible lending that they are competing with is harming their businesses. It's harming their portfolio quality as their borrowers get dragged down. It's harming their customer acquisition. A friend at one of the large bank trades was telling me about how he had joined that trade from a bank and where he was in small business lending, and found that it was harder and harder for the bank to find businesses to lend to who hadn't already taken unaffordable financing. And that's also harming the bank's deposit growth too. So there's a lot more consensus there.
Well, all right, you said banks are exempt. What about a bank that partners with a non-bank? Is this a way for the non-bank to avoid the compliance responsibilities that might exist under various state laws?
Yeah, well, one thing that you've raised is that compliance can be a challenge for small companies. Complying with the quote unquote patchwork can be a challenge. And so a lot of companies do utilize these issuing bank partnerships, banking as a service partnerships to operate in multiple states. For some of these truth in lending laws, that doesn't actually insulate them from compliance with the transparency requirements, because the transparency requirements don't apply to the lender, who is in these cases perhaps the bank. They apply to the party that is presenting the offer of credit. And so if I'm a non-bank and I have a bank that's the lender of record, but I am the one that's presenting the offer of credit. I am what is called the provider in the definitions of the law, and thus I am subject to being transparent about the price.
Uh-huh. But if the non-bank is just simply acting as a broker and referring the borrower to a bank, and the bank ends up making the disclosures, the non-bank is off the hook, I take it.
Again, I mean, that's my understanding, and I should mention I'm in the presence of great legal expertise. I'm not a lawyer, and I'm not giving legal advice.
Oh, okay. I thought, sure, you were a lawyer. You know much more than most lawyers know about the area that you're in. So I want to end by asking you, because we've really come to the end of our time, where do you see small business financing law and regulation going in 2026?
Yeah, there's going to be more. Like we've said, there's been more activity at the administration, at the federal level, in red states and blue states. More and more states are introducing these. And I think my main message about this is that this issue is not going to go away on its own. As long as we are seeing more than a quarter of small business owners say that they are being harmed, more than a quarter of business owners in the last 12 months say that they were harmed in the last 12 months by predatory lending, legislators are hearing about this and they're going to be doing stuff. And so, I think that some of the legislative efforts that we see that are really just efforts to kind of push this issue under the rug, that's not going to solve the problem. That's not going to make it go away. The only way to really make this go away is to solve it. And what we want to see is that solved in a way that is good for small businesses and is good for innovation, is good for responsible lending. And so I think organizations that are at the table, and we invite everybody to join with us in that, in constructive ways, are the ones that are going to help shape what those solutions really are going to look like in the next year.
Yeah. Okay. Well, Louis, I want to thank you for what I thought was an excellent discussion about a topic that we have unfortunately we really ignored it on our podcast show, but today I thought it was about time we got into it. And let me end with a few takeaways. As you've been talking, I've been making some notes. And this is how some of the thoughts I'd like to leave with our audience before we sign off. First of all, state regulation of small business lending is here to stay. It's no longer the exception, it is becoming the norm. Companies offering commercial loans or advances must assume that cost disclosures, registration, licensing, and some substantive restrictions will apply in many states. They don't exist in all, and you've told us, I think about 19 states have some kind of
19 laws, I should say.
19 laws.
With some states, multiple laws.
Yeah, but I think the number of states will continue to increase. Second, the new statutes, these statutes deliberately borrow from consumer loan concepts. Legislators are importing APR-style disclosures, some fee limitations, not on interest rates, but I think there are some, am I right? Some restrictions in a few states on fees.
In California, there is a junk fee prohibition, but that's mostly covering where there are fees where people are just being charged fees for nothing, or fees that are like grossly excessive. So they're not caps on origination fees or something normal.
Contract fairness principles. Some of these statutes have UDAP kinds of coverage. I mean, I know a lot of state laws apply not only to consumer transactions, but also B2B transactions. So maybe they're not in the specific state statute, but they're in a UDAP law that applies to not only consumer transactions, but B2B. It reflects, I think, a concern that typical Main Street borrowers resemble a consumer more than a large corporation with a corporate treasurer and a infrastructure that includes legal compliance and a lot of other areas. Third, the patchwork nature of these laws does create significant compliance challenges, even though I recognize that your organization has made great strides to try to make these statutes as uniform as possible. Wonder why, just as I'm thinking about it, Louis, did you ever go to the uniform commission, the commissioners on uniform state laws?
Yeah, actually, there is an active uniform law commission process underway right now. It's quite interesting. It was actually brought to the Uniform Law Commission by the merchant cash advance industry, by the Revenue-Based Finance Coalition. And they, in my estimation, approached the Uniform Law Commission as a tactic to try to appropriate the credibility of the Uniform Law Commission to put forward a bill that would not have APR and would sort of advance their effort to prevent meaningful transparency from happening. And there's a lot of smart people in the Uniform Law Commission, and they've been listening to the arguments of the merchant cash advance, basically the general like anti-transparency entities and other lenders and voices that care about establishing transparency for small business owners. And to a large extent, that's been kind of blowing up in the MCA's faces. And at this point, the Uniform Law Commission draft does include an estimated APR, which is the right way to do it for merchant cash advances. It needs to be and should be identified as an estimated APR. And that's sort of the trend overall on this transparency issue is that, the opponents of transparency have been able to sometimes win when they can kind of do it in the shadows. And when it sort of sees the light of day and there are real arguments that go back and forth and people are able to really fully consider this stuff, they tend to say, gosh, why would we just not tell a small business owner what financing is likely to cost?
Yeah. Is your organization involved? Are you one of I don't know if they have boards of advisors or?
We are involved.
You are. I figured you would be. So this is I guess, two more takeaways. Transparency, you've mentioned it over and over again, and access have to be balanced. Well-designed disclosures can empower borrowers, but overly rigid rules or licensing requirements that are difficult to obtain may unintentionally reduce the flow of capital to the very businesses that the laws aim to help. And finally, I think we should expect more states to go down this path and for enforcement activity to increase at the Federal Trade Commission, probably not the CFPB, at least until there's a different administration at the top. And understanding these developments is really essential for anybody participating in or advising small business credit. This trend has also had a big impact on law firms like ours that have well-established consumer financial services practices. I founded our practice about 30 years ago, and I chaired the practice group for 25 years. And then when California enacted their law, I got together with the leadership in our practice group and said, we've got to expand into small business lending. It's a natural area for us to get into. And so we did that around 2018, and we expect that's a growth area of our practice. So to make sure that you don't miss any future episodes, please subscribe to our show on your favorite podcast platform. Don't forget to check out our blog, consumerfinancemonitor.com, for daily insights on the consumer finance and the small business lending industry. If you have any questions or suggestions for our show, please email us at podcast, that's singular, podcast, at ballardspar.com. Stay tuned each Thursday for a new episode of our show. Thank you very much for listening, and have a good day.